fundsupermart.com.
Hi, what are some of the key macroeconomic challenges in emerging Asia?
Well, I think that we should look back over the last couple of years and say we're in a much better place today in terms of the global economy and in terms of the Asian economy than we have been at any point over that period. Things have steadily been improving, and we're definitely globally established much more on a growth track. So that's very positive. Having said that, Asia is a place which is very exposed to the economic cycle. It's a very cyclical economy, particularly in emerging Asia. And that means that it should benefit greatly from a pickup in world growth. And that's good because we are entering that portion of the cycle where we're expecting that pickup to come. What we would say, however, is that probably that is going to take a bit longer than most people are expecting at the moment. So I think that we're going to live in a world where we have relatively low interest rates, low inflation, and below trend growth for a bit longer than we'd like. So I think we were previously, as an investor community, expecting growth and interest rates and inflation to pick up maybe later this year, maybe early next year. I think that's going to be pushed back a year or two, which is not a terrible outcome. It should allow interest rates to remain low, monetary policy to remain very accommodative, but that also means that Asia is not going to get the boost from global growth that we were perhaps expecting. So I think that's the major trend that's going on, and one of the challenges for Asia at the moment.
Income-themed funds have been popular among investors. What is your outlook on Asian stocks that offer growing dividend yields, and what are the fundamental factors behind this trend?
Okay, that's a great question. I think this is a really interesting area, but I think, first of all, Asia is a region where dividends really matter, and that often gets overlooked. Most investors in Asia chase after growth. And they don't think about income, they don't think about payout ratios, they don't think about dividends so much. But if you look back historically, more than 50% of the total return for investors in Asia has come from dividends. So it is very, very important. And on top of that, there are very good dividend-paying companies in Asia, very high-quality companies that pay out a big chunk of their earnings in dividends and have done very well historically. For example, it might surprise you to know that a bigger percentage of Chinese companies pay dividends than American companies do, than US companies do. I think that's a surprising thing for most people. So definitely Asia is a place where you can find really quality companies paying good dividends and growing dividends. Now, having said all of that, I think any investor going into a strategy that is focused on the higher dividend paying companies needs to be aware that this is in effect a constrained strategy. You're preventing the fund manager in that strategy from buying certain types of companies. You're forcing them only to buy companies that are paying high dividends. And we would say that's not the best investment strategy over the long run. So we have a really good Asia dividend strategy. Performance is great, but we would say to investors, if you ask us, if you want our advice, go into the core strategy, go into an unconstrained strategy where we can still buy those types of companies, but we're not forced to do so. We can decide to do it when it's appropriate. The final comment I would make is that dividend investing, focusing on those high dividend companies in Asia, has worked remarkably well for a long period of time. There is no fundamental, academic, or other reason why that should continue to work so well. It just doesn't add up in the long run. So I think it's time for investors to reassess their approach to equity income strategies and maybe think about a more core approach, despite the very, very good conditions that do exist in Asia for those seeking dividend income.
Within Asia, what are the sectors or industries that are expected to outperform?
Okay, so again, that's a great question. What I would say is that cyclical sectors and financial sectors, which are of course also cyclical, should do very, very well over the next year or two in Asia. And there's a couple of reasons for that. Number one, from a valuation perspective, those sectors are really cheap compared to the broader market and compared to the defensive sectors. The reason for that is that people have been so concerned about the economy over the last 2 years that they've really, really favored the defensive stocks. And the defensive names have really been bid up. They're so expensive now, 40, 50% more expensive on average than cyclical and financial names. And that just does not make sense. That can't be sustained. And that has to change. And it's in the process of changing. A big thing that's happened over the last 2 months is that that's beginning to reverse. And we think it's got a lot more to go. So getting exposure to those cyclical, to those financial names, I think is a really good idea for investors today. Secondly, I would say that's what we would expect to see in this part of the economic cycle. As people's concerns about the global economy and the Chinese economy and other important economies subside, as people gain more confidence about the state of the world and the economy, those cyclical companies should do very, very well. Actually, they're already very profitable on the whole. They don't have a profit problem. They're very cheap. What they have is a perception problem in investors' eyes, in investors' minds. And I think that's changing. So I think that's a really big trend for the rest of this year in Asia, and one that investors can benefit from a lot.